Welcome back to the game of life, where we take the complexities of life and turn them into actionable strategies. Today, we're diving into the world of investing with a concept that's as simple as it is powerful: traffic light investing. Imagine for a moment that the stock market isn't a chaotic whirlwind, but a busy intersection, and you're the driver. Let me ask you this. Have you ever hesitated at a green light in life, unsure whether to move forward, or slammed on the brakes at the wrong moment, only to watch everyone else cruise by? Investing is no different. By the end of this episode, you'll have a roadmap to navigate the financial highway with confidence, knowing when to accelerate, when to ease off, and when to come to a full stop. And here's the best part. Mastering this system isn't just about money. It's about building a mindset that works in all areas of life. Stick around. There's a big reward waiting at the end. Oh, and to lighten the mood, why did the investor bring a stoplight to the stock exchange? Because they wanted to control the market's traffic. Spoiler, it didn't work. Let's start with the basics. Traffic lights are there to guide drivers, keeping us safe and moving smoothly. In investing, the same principles apply. The world of finance can feel like a bustling intersection, full of opportunities, risks, and decisions. The traffic light system breaks it down into three simple phases. 1. Green light, when the road is clear and it's time to invest aggressively. 2. Yellow light, when caution is key and you need to slow down. 3. Red light, when all signs point to danger and it's best to stay put. Now, think back. How many times have you felt unsure about an investment? Maybe you hesitated, or maybe you rushed in too quickly. The traffic light system is here to change that. Let's talk about the green light, the go-ahead to invest with confidence. This is when the market is favorable, opportunities are abundant, and you have clear signals to move forward. Imagine you're shopping during a clearance sale. Everything you've been eyeing is now 50% off. It's a no-brainer, right? The same applies to investing. Green lights flash during market dips, undervalued stock opportunities, or after major innovations disrupt an industry. These are the moments when history rewards those who act decisively. Take Warren Buffett's approach as a case study. He's made billions by stepping on the gas when others hesitated. His advice? Be fearful when others are greedy, and greedy when others are fearful. Ask yourself, are you ready to recognize a green light? Or are you still sitting at the intersection, watching others move forward? Now let's hit the brakes. Not a full stop, but a slowdown. The yellow light is your signal to proceed with caution. This is where your instincts and analysis come into play. Imagine this. You're on a road trip and the weather turns foggy. You don't pull over, but you also don't floor it. Instead, you adjust your speed and focus. In investing, yellow lights often appear during market booms. Prices are climbing, but warning signs like overvaluation or unsustainable growth begin to flash. Think back to the dot-com bubble of the late 90s. Investors were euphoric, but the ones who slowed down and evaluated the risks were the ones who came out unscathed. Ask yourself, are you chasing trends without understanding them, or are you pacing yourself to avoid a crash? Think of buying a house in a hot real estate market. You're cautious about overpaying, but don't want to miss out entirely. Yellow light investing is all about balance. And now, the red light, the ultimate warning. This is when the market is screaming, stop, and the smartest move is to stay put. Whether it's during a financial crisis, an overheated market, or global uncertainty, red lights protect you from unnecessary risk. Here's a compelling real-life scenario. Picture this. It's 2008, and the financial world is in absolute chaos. Banks are collapsing, stocks are plummeting, and the news is a constant stream of doom and gloom. Panic spreads like wildfire, and many investors, driven by fear, make knee-jerk decisions. They sell their holdings at devastating losses, thinking they're cutting their losses, only to realize they locked in the damage and missed the eventual recovery. Others take the opposite approach. They dive headfirst into the turmoil, trying to catch falling knives, convinced they've found the bottom. But instead of seizing opportunities, they bleed further as the market continues to tumble. It's a harsh and expensive lesson about timing the market. This is where the concept of red light investing comes into play. Imagine approaching the financial markets like driving in a storm. The red light is your signal to stop and assess the situation, protecting your capital while the storm rages on. It's not about being paralyzed by fear, but about staying grounded, watching, and waiting for conditions to stabilize before making your next move. Red light investing isn't flashy. It's about discipline, patience, and playing the long game. While others are gripped by fear or overconfidence, you're preserving your resources, ready to act when the storm clears and opportunities shine again. It's a mindset that separates the seasoned investor from the impulsive gambler. Picture yourself at a literal red light. You're in a hurry, but you know running it could end in disaster. Sometimes, stopping is the most powerful move you can make. Ask yourself, are you acting out of fear or impatience, or are you waiting for a clearer signal? Quick pause. If you're finding this video helpful, why not share it with someone who could benefit too? A simple recommendation from you means more than anything and helps our community grow. Here are some common questions and answers. 1. Isn't green light investing just about chasing trends and buying aggressively in a booming market? Not exactly. While the green light in traffic signifies go, in investing, green light moments don't mean reckless buying. Instead, they represent times of clear opportunity when conditions align with your strategy, risk tolerance, and research. These are moments when the fundamentals are strong, the market sentiment is favorable, and you've done your due diligence. For example, buying into an emerging industry like renewable energy during a government policy shift promoting sustainability could be a green light. However, blindly chasing trends, like the infamous dot-com bubble of the early 2000s, can lead to disaster. Many investors jumped into tech stocks without understanding the business models, and when the bubble burst, they suffered massive losses. The hidden truth? Even in a green light market, only about 20% of the opportunities are genuinely lucrative. The rest are often hype-driven, making careful analysis essential. 2. Isn't yellow light investing just another term for indecision and missing out on opportunities? Not at all. Yellow light investing isn't about indecision. It's about caution and strategic action. Think of it as a moment to slow down and analyze. When markets are volatile or overvalued, the yellow light signals you to tread carefully, not to rush. For instance, during a period of high inflation or geopolitical tension, you may see a mix of bullish and bearish signals. The key here is to focus on protecting your portfolio by diversifying, adjusting allocations, or even holding on to cash. A hidden fact about yellow light investing is that some of the most successful investors thrive in these moments. Warren Buffett's famous mantra, "Be fearful when others are greedy, and greedy when others are fearful," reflects yellow light thinking. He takes calculated risks when the market is uncertain, often buying undervalued assets. The real edge comes from understanding that hesitation isn't weakness, it's strategy. 3. Isn't red light investing just sitting on the sidelines and wasting time while others profit? Not quite. Red light investing is about preservation and avoiding unnecessary risks. It's a defensive stance during extreme market conditions, such as economic recessions, asset bubbles, or financial crises. While it might feel like missing out on gains, red light investing ensures you don't incur catastrophic losses when the market crashes. For example, during the 2008 financial crisis, legendary investor Ray Dalio avoided significant losses by anticipating the crash and adopting a red light strategy. A lesser-known fact? Many investors fail to recognize red light moments because they're emotionally driven by FOMO, fear of missing out. Research shows that over 70% of retail investors make costly mistakes during market downturns by either panic selling or buying prematurely. Red light investing teaches discipline. Sometimes the best move is to pause, preserve capital, and wait for clear signals to re-enter. Here are some hidden facts about traffic light investing. 1. Green light investing often aligns with market cycles and investor psychology. The market follows a cycle: optimism, green; caution, yellow; and fear, red. Understanding where you are in this cycle can save or make you a fortune. For instance, bull markets create FOMO, but only disciplined green light investors who avoid overvalued assets thrive long-term. 2. Yellow light investing reveals hidden gems. Many undervalued stocks or assets emerge during yellow light conditions because market participants are overly cautious or unsure. Savvy investors can identify these opportunities through rigorous fundamental analysis. 3. Red light investing is not just about waiting, it's about preparation. Successful red light investors don't just sit idle, they actively research, adjust their portfolios, and plan their next moves. For example, cash reserves built during a red light phase provide the liquidity to act when green light opportunities arise. 4. Traffic light investing isn't about the market alone, it's about you. Your financial goals, risk tolerance, and investment horizon dictate your traffic light more than external conditions. A young investor with decades to recover can afford green light risks, while a retiree might prioritize red light caution regardless of market sentiment. By mastering when to go, slow down, or stop, traffic light investing becomes a powerful framework to navigate the ever-changing financial landscape. Let's bring it all together. How do you apply the traffic light system to your investments? Here are 3 actionable steps. 1. Learn to read the signals. Stay informed about market trends, economic indicators, and company fundamentals. The more you know, the clearer the lights become. 2. Control your emotions. Fear and greed can cloud your judgment. Use the traffic light system as a rational framework to guide your decisions. 3. Be patient. The best opportunities often come to those who wait. Investing isn't a sprint, it's a marathon. Here's the reward for mastering traffic light investing: clarity and confidence. Imagine no longer second-guessing your decisions. Picture yourself navigating the financial highways with ease, knowing exactly when to go, when to slow down, and when to stop. This isn't just about money. It's about cultivating a mindset that applies to all areas of life. The next time you face a tough decision, whether in investing, relationships, or career, remember the traffic light system. It's a reminder that timing is everything. Conclusion, encouragement, and gratitude. Thank you for joining us on the Game of Life. Remember, investing doesn't have to feel like driving in the dark. With the traffic light system, you've got a clear, actionable guide to navigate the twists and turns. If you found value in today's episode, share it with someone who could use a little clarity in their financial journey. And as you move forward, keep this in mind. Life, like investing, is about knowing when to push forward, when to pause, and when to wait. Until next time, keep playing the game of life with wisdom, courage, and strategy. Take care.